Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, August 8th, 2025. Hope everyone's having a great week. So, as always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro questions are markets adequately priced for regime change at the Fed, part four? And should 401ks be exposed to alternative assets? Our answers: our 2-year-old forecast for much needed regime change at the Federal Reserve was incrementally ratified after two developments yesterday. And no, markets are not adequately priced for this risk. First, Bloomberg reported that Fed Governor Christopher Waller is the leading contender to replace Fed Chair Jerome Powell when his term ends in May. He is allegedly favored by President Donald Trump's advisors for his forecast-driven policy approach, a departure from the current data dependency championed by Chair Powell. Recall that Powell's backward-looking approach has led to five major policy mistakes throughout his tenure. Too late to stop tightening in 2018, too late to ease in 2020, too late to start tightening in 2021, asleep at the bank supervision wheel in 2023, and too late to start easing in 2025. Sources also cite POTUS appreciates that Waller has deep knowledge of and relationships within the institution, something that would help him implement regime change if Waller is on board with Paradigm C. Time will tell on that. Second, President Trump nominated Council of Economic Advisors Chairman Stephen Moran to temporarily fill Fed Governor Adriana Kugler's seat expiring in January, pending U.S. Senate confirmation. Dr. Moran, a Harvard PhD, shares Trump's call for lower rates, is a measured communicator, a sharp Fed critic, and backs unconventional reforms. With regard to the medium to long-term outlook for monetary policy, Moran recently stated, overall, we don't expect significant inflation from the tariffs, and if it occurs, it would be a one-time price level shift, not an enduring trend. A view contrasting with Jerome Powell's July 30th warning that the inflationary impacts of tariffs could instead be more persistent. Dr. Moran's view suggests he can inject much-needed credibility into the other side of the debate surrounding the impact of tariffs on inflation. Dr. Moran represents a Trojan horse that can help the FOMC understand the following. Number one, tariffs are not inflationary. Number two, a 2% inflation target is arbitrary. And number three, an economy growing 3 to 4% on a real basis with 2 to 3% inflation is far better for the median household than an economy growing 1 to 2% because of a firm commitment to an arbitrary 2% inflation target. Elsewhere, President Trump signed an executive order on Thursday opening 401ks up to private equity, real estate, cryptocurrency, and other alternatives, directing the Labor Department to reassess their recent guidance within 6 months. The 401k market represents a massive opportunity for liquidity for alternative asset managers, given the multi-year trend of subdued capital markets activity. We can only hope that Wall Street doesn't turn Main Street into bag holders again by marketing only the lowest quality private equity and private credit assets to retail investors, i.e. the assets they cannot sell without a significant haircut. Refer to the recent divestiture of private equity assets by my alma mater, Yale, and the recent debt raise by our rivals, Harvard, for more details. So obviously, Yale and Harvard were, Yale specifically, but Yale and Harvard were obviously up front in terms of getting into the alternative asset class. And so Yale's struggling to get out without significant haircuts on some of its private portfolio. And obviously, Harvard couldn't get out at all. That's why they had to raise, almost $1.5 billion in debt this past spring. So I'm hopeful that Wall Street doesn't turn Main Street into bag holders by selling them a bunch of low quality products in the alternative space. But who's to say what's going to happen there? But all we know is I'm grateful that 42 Macro exists so that we can help Main Street navigate all these pending changes, not just in the economy, but also from a regulatory standpoint, so that you guys don't wind up being the bag holders as you tend to be, throughout these market cycles. So transitioning to our 42 Macro dashboard, as always, we'll wrap up with a question from our community. This one's titled Stop Loss. It reads, I have the vast majority of my wealth invested in KISS. So far, so good. We've been in a bull market since I joined 42 Macro on June 23rd. There have been no pivots since I joined. But I'm starting to get nervous about some sort of black swan event like China invading Taiwan or the bond market breaking. I really don't want to lose my life savings due to unforeseen circumstances. I am not a rich man. I am considered lower middle class based on the cost of living and median income in Southern California, where I reside. I don't have any assets outside the money invested in my brokerage account. Darius, would you recommend that small retail clients like myself use stop losses just in case something crazy happens? I trust your process, but nothing is 100% bulletproof. I would appreciate your thoughts on using stop losses. So, first off, I just have to say I'm really grateful and humbled that we have people who consider themselves lower middle class among our client base. I'm someone who grew up at the very bottom of the lower class of our K-shaped U.S. society, someone who spent time in and out of homeless shelters, time living in vans, time living in motels, time sleeping on neighbors' couches. You know, I can go on and on and on about all the hardship that I struggled with throughout my childhood. And so I'm really grateful that I can pay it forward in terms of the solutions that we're building. We have built very effective solutions that we've built for retail investors around the world, and I'm really grateful to be partnered with this client here. With regards to what you should be doing specifically, now I'm talking to the client. That's not what we do here at 42 Macro. We don't provide specific investment advice for individuals. How you structure your portfolio, respond to our research is totally up to you. All our research is general in nature. The one thing I will say is that I don't know what your stop losses are going to be. Not you, but if you're going to think about putting stop losses on your portfolio, the thing I would say is, I bet they're probably going to be worse than our risk management overlays. The whole point of our risk management overlays is to implement risk management, signaling into KISS. We add vol targeting with our market regime nowcasting process, and we add dynamic position sizing with our volatility adjusted momentum signal. I guarantee you our market regime nowcasting process and our volatility adjusted momentum signal, which are based on proven quantitative techniques from decades of research, they'll tell you that I guarantee you both of those signals are better than your arbitrary, lick your finger in the air stop loss. And so the reason for that is, one of the things that makes our models, very effective, and something that obviously Wall Street has figured out a long time ago, is that volatility is a leading indicator for price changes. And so our volatility adjusted momentum signal, which we built, kind of standing on the shoulders of the giant Benoit Mandelbrot and his work, his seminal work and the subject matter, we understand that volatility is a leading indicator for price. So that's why we have our volatility adjusted momentum signal. What a stop loss is a pure price momentum signal that says, get me out, sell this position, perhaps at a steep discount, or panic sell the lows whenever the price momentum signal crosses a certain threshold. What our volatility adjusted momentum signal has proven across multiple market cycles now since we started this firm, but also in our rolling out a sample back test, is that our VAMP signal actually causes investors to change their positions much faster than you otherwise would be if you were just relying on technical indicators or a price momentum signal like a stop loss would be. So that's a long-winded way of saying, yeah, you could use a stop loss, but I'm almost certain that it's going to be a lot worse than our institutional grade risk management overlays. Most of the hedge funds on Wall Street wouldn't be able to charge 2 and 20 and 3 and 30 to their clients if their clients could just put a stop loss order in. You know what I mean? The reason these people get paid to manage market risk and market cycles and to stay on the right side of market risk for their clients is because they have the ability to create tools and solutions that are more effective than the stuff that you can pull off the shelf from your 1-800 brokerage account. You know what I mean? So you can keep pulling stuff off the shelf and dumping it in your portfolio from your 1-800 brokerage account, but I guarantee you're going to have worse results than me, myself, who's using KISS to manage my entire liquid net worth as a former dirt poor person who grew up standing in food bank lines and all kind of stuff, eating pork and beans out of a can, in a roach infested motel. I got a bunch of stories about all the hardship that I faced, and I'm telling you right now, I'm using KISS to manage my entire liquid net worth as someone who is first generation rich and refuses to go back to that lifestyle. So you guys can obviously trust that what we built here is very effective, and most importantly, principally designed to cut off left tail risk from portfolios. And quite frankly, that's I've always believed that the markets will make the money for you. If you're out there trying and trading and trying to make money in financial markets, you're doing it wrong. The markets go up over time. Just let it go up for you. The money is made in the waiting, not in the trading. Was that Charlie Munger, Warren Buffett? It's the left tail that you need to be focused on as investors, and what we do for our institutional clients at a high level, at a very effective level, and obviously what we've built for the retail investor audience via KISS. That stuff is expressly focused on risk managing the left tail and making sure that we don't suffer significant outsized drawdowns in our portfolios. Obviously, KISS is, primarily, it is a trend following system that's built on our market regime nowcasting process and the volatility adjusted momentum signals for stocks, gold, and Bitcoin. And it obviously raises cash dynamically based on those signals, when things are starting to get hairy. If we had some sort of left tail rate, like if China invaded Taiwan right now, obviously we would be ill positioned for that. All investors in the world would be ill positioned for that. So, I don't live in fear of nuclear bombs going off in Manhattan. Look, our goal is to take risk as financial market participants. If we weren't taking risk, we would not be making any money. No one's going to give you money to sit there with 100% 0% risk in your portfolio. If you have 0% risk in your portfolio, guess what? You're going to make $0. You have to take risk to make money in financial markets. And ultimately, what we built here are solutions that we've proven, like we talked about yesterday in our testimonials page, hundreds of testimonials from clients all around the world in 80 countries around the world telling you that what we've built keeps them on the right side of market risk. It's highly effective at risk managing bear markets, and it's equally effective at keeping them on the right side of market risk, i.e. maximizing upside capture during bull markets as well. So that's about it. I'll wrap it up there. Darius Dale here, presenting our Macro Minute for Friday, August 8th, 2025. Best of luck out there. Appreciate everybody for partnering with us, and we'll catch you back here on Monday. Have a great weekend.